Hello, I'm Emma Wall, and joining me today is Job Curtis, manager of the City of London Trust. Hello, Job.
Hello.
So for various reasons, sentiment towards UK stocks has been depressed recently, but despite share prices being lower than historically, dividends seem to be doing okay. Is that fair?
Yes, dividend growth has been low single-digit percentage growth, which is not bad. There have been some high-profile dividend cuts, but across the market overall, dividend growth is reasonable, and combined with a 4% yield from the UK equity market, that's pretty attractive relative to the main alternatives.
And for you then, as an income investor, this must present opportunities because you've got that interesting entry point at share price level, but still presumably quite exciting prospects for dividends.
Well, yes, the market has obviously done well over the years, but as you said earlier, the market has underperformed some overseas markets, particularly last 3 years. And so there are definitely opportunities, and some of the domestic stocks within the stock market are particularly depressed about political Brexit type concerns. So the core of City of London's portfolio is in global UK listed stocks, but we do have some interesting domestic stocks as well where there's a lot of potential.
Now, Brexit seems to be changing on a daily basis, so it must make it very difficult to make any investment decisions based on the politics. How do you ignore that noise and sort of zero in on the opportunities?
Well, I think the key thing is to stick to the companies and the valuations and the dividends. I mean, there's an old phrase about being paid while you wait, and if you're sitting on a stock with a 4% yield growing at a decent pace, and that's a sort of, you could put up with a lot of the volatility of Brexit or the other geopolitical factors like rising tariffs globally.
And where are you seeing the greatest opportunities at the moment?
Well, I think there is a lot of potential in some of the domestic stocks. I mean, there's some very attractive yields out there. I mean, Lloyds Bank, which has rebuilt its capital ratios substantially since the financial crisis and is now yielding 6%. And the house builders, I think, look very interesting. The biggest holding, Lloyds is a big holding in City of London. Our biggest house building holding is Taylor Wimpey, which is, in fact, I expect to have a dividend yield of around 10% at today's share price. And I think there's a lot of demand across the UK for housing. Interest rates are low, unemployment's low, so it's quite a good backdrop for the house builders at the moment.
You did, however, say in your earlier answer that there has been volatility, and I think it's safe to say that investors should expect this to continue.
Yes, I think there's a lot of geopolitical issues, out there, and as well as our own politics. So I think there are a lot of factors there. I mean, we have at City of London at the core of our portfolio large global companies like Diageo or Unilever or Old Dutch Shell, HSBC. So these are, great core companies which I believe will be consistent in the long run. But as I say, the dividend outlook is reasonable, and I think that is something that should give investors comfort.
Job, thank you very much.
Pleasure.